Welcome to another case study by Blueprint to Escape. I'm your host, and today we are absolutely going to town on a sector that, let's be honest, usually puts people to sleep.
Right. The boring stuff.
It's the kind of stuff you buy for your grandmother's portfolio so she doesn't call you in a panic. But right now, in early 2026, it is arguably the only thing letting investors sleep at night.
It really is. It's a fascinating moment because we're seeing this flight to safety that's actually generating serious growth.
Yeah.
Usually you have to pick one, right? Safety or growth.
Right.
Right now, this sector is giving us both. It's a have your cake and eat it too scenario, which, almost never happens.
Exactly. We're talking about the utilities and energy sector. But before we dive into the why and the specific tickers, we need to address the elephant in the room.
Ah, yes.
We put out a video version of this case study recently, and we need to make a correction. We're all about transparency here, so let's clear this up immediately.
Right. In the heat of analyzing the charts for the video, and there were a lot of charts, there was a small mix-up on the total returns for the last month.
Yeah, so let's set the record straight right now. In that video, we mentioned that UTES had the massive 13% return. That was a mistake.
Right.
The actual star of the show, the fund that pulled in that incredible 13% total return between mid-January and mid-February 2026 was HUTE, the Harvest Equal Weight Global Utilities.
Exactly. That distinction is important. And look, the Evolve Canadian Utilities Fund has still had a fantastic run. It returned a very, very respectable 9%.
Oh, absolutely.
But HUTES was the one hitting those double digits in capital appreciation in just 1 month.
So just to be crystal clear,
Yeah.
HUTE did 13%, UTES did 9%. And honestly, whether it's 9% or 13%, when you compare that to the broader market, it's mind-blowing.
It is.
I mean, looking at the TSX and the SP500 for that same period, what were they doing?
Basically nothing. They were flat or, in some cases, slightly down. The market has been incredibly turbulent since the start of 2026. Volatility is back. So to have a traditionally boring sector outperforming the major indices by that kind of margin, that is a significant signal. That's not noise.
It's the irony of it all, right? You think utilities, you think safety, slow growth.
A small dividend check.
Yeah, a dividend check to buy a coffee once a quarter.
Yeah.
You do not think market-beating growth engine. But that's what's happening. This is shaping up to be our fourth favorite sector for 2026, right after that 3 best escort content we covered.
We certainly do cover a wide range of assets here. But yes, utilities are climbing the ranks. And the mission of this case study is really to guide you, whether you're in Canada or the U.S., through why this shift is happening.
Not random.
Not at all. We're going to break down 3 specific ETFs, UTEC, UTES, and UMAX. These are the tools we're using to blend that defense with some real offense.
So let's unpack this. Why now? Why is 2026 the year of the utility company? Is it just people hiding from the volatility in tech?
That's part of it. It comes down to the macro environment. We entered 2026 on shaky ground. When the market gets rocky, investors naturally look for stability. Right.
They look for the things that people cannot live without, regardless of what the economy is doing.
The backbone of the economy, as we called it in the case study.
Precisely. No matter what the stock market does today, you still need to charge your phone. You need to heat your home. You need water, gas, electricity. These are non-negotiables.
Okay, sure. I get the defensive argument. Demand for electricity is stable. That explains why these stocks don't crash when the S&P wobbles.
Right.
But stability doesn't explain a 13% jump in 30 days. There has to be something else fueling this. Stability is usually, well, it's flat, it's boring.
You're right. Stability alone doesn't create alpha like this. And here's where it gets really interesting. It's not just about residential stability anymore. The game has changed.
How so?
It's changed because of 2 letters. AI.
Artificial intelligence?
Yes. We are seeing a massive surge in electricity demand due to electrification and, more importantly, the exponential growth of data centers required to run AI models.
Because AI isn't just code floating in the ether, right? It lives on servers. It lives on massive racks of servers that generate immense heat and require immense power. An AI query uses significantly more energy than a standard Google search.
Wow.
We are talking about building out the physical infrastructure of the digital age. These data centers are incredibly power hungry, and they need that power 24/7.
So the utility companies are basically selling the pickaxes for the AI gold rush.
In a way, yes. Or they're selling the water to the miners. They supply the raw energy needed to process all that data. And because of this projected demand, we are seeing massive CapEx programs.
Capital expenditure.
Exactly. Provinces and companies are pouring money into grid upgrades.
Can you clarify that for people? Because we hear CapEx and usually think of companies spending money, which hurts profits. Why is high spending a good thing here?
That's a great question because it is counterintuitive. In the regulated utility world, the economics are different. When a utility spends money on infrastructure poles, wires, new generation, it expands their rate base.
And the rate base,
It's the value of the assets that they are allowed to earn a set regulated return on.
so the regulators effectively guarantee a profit on that spending.
Exactly. A bigger rate base means they can charge more, which leads to predictable earnings growth. Look at EMRA, for example. They have a $20 billion capital expenditure program planned through 2030.
Billion.
That's $20 billion of investment that will eventually flow back as regulated earnings.
That's a key insight. Spending equals growth in this sector. And I suppose the policy environment helps too, with rates.
It does. We're seeing policy pivots, potential rate cuts. Utilities are capital intensive. They borrow a lot of money. When rates go down, their borrowing costs drop and profits go up.
It's a perfect storm.
It really is.
Okay, so the macro picture is solid.
Yeah.
Let's get into the nitty-gritty of the case study data. Let's start with the heavy hitter we corrected, HETE.
The Harvest Equal Weight Global Utilities Enhanced Income ETF.
This is the one that did the 13% total return. But it's not just about the stock price going up, is it?
No, and this is key for the blueprint strategy. It pays a monthly yield of 9.39%.
Nearly 9.4% yield plus 13% growth in a month. I mean, that sounds almost too aggressive for a utility play.
Well, the enhanced income part is a clue, but the key distinction with HUTE is the word global. It's not just Canadian companies.
Why is that important? Why not just stick to local?
Diversification. Different countries have different regulatory environments, different growth cycles. We started buying this one in late January 2026, right as we saw this rotation starting.
Smart timing. Okay, next up is the yield monster, UTES, the Evolve Canadian Utilities Enhanced Yield Index Fund.
This one is a long-term holding for us. Now, even though it only returned 9% recently, which is still beating the market handily, the yield on this is staggering.
I have the number here and I had to double check it. 17.12%.
Correct. Over 17% annualized yield paid out monthly.
That is massive. But I have to play devil's advocate. When I see a 17% yield, my first thought is dividend trap? Is this sustainable?
That's the right skepticism to have. But holding UTES has been crucial for portfolio defense. While parts of the portfolio like tech, fintech, blockchain were taking a beating.
It's the counterbalance.
Exactly. UTES was just chugging along. Even if the share price stays flat, you are collecting 1.4% in cash every single month. It mitigates those downturns. It's the anchor.
Okay, let's talk about the third one.
Yeah.
UMX, Hamilton Utilities Yield Maximizer ETF.
So UMAX returned about 6% from mid-Jan to mid-Feb. The yield is 14.26%. But the reason we like UMX is the context. It's not just pure electric utilities.
It's got a bit of a different flavor.
It has a 23.7% allocation to pipelines. So you are capturing that utility stability, but you're also getting exposure to energy sector momentum. It's a hybrid.
And pipelines act a lot like utilities, don't they? They're like toll roads for energy.
Exactly. Long-term contracts, regulated fees, it fits the theme perfectly.
And we need to clarify the ownership on this one, right? Because we don't just go out and buy UMAX directly.
That's a good point. We don't own UMX as a standalone ticker. However, it is a major component of Hamilton's HDIV. And since HDIV is a huge chunk of our portfolio, about 16%, we effectively own a lot of UMX indirectly.
So we're getting that exposure anyway. Now, I want to pause on the how. We're throwing around yields of 14%, 17%. How are these ETFs doing that?
Right, there's no free lunch. This is the enhanced part of their names. These ETFs all use a covered call strategy.
Okay, break that down for us quickly.
So essentially, the fund owns the stocks, the utility companies, but they also sell call options on those stocks. They're selling the right for someone else to buy the stock at a higher price in the future.
And for selling that right.
They get paid a cash premium instantly.
So they are trading some of the potential future upside for guaranteed cash right now.
Exactly. That cash premium is what funds these massive monthly distributions.
So the risk is, if utility stocks suddenly double in value, these funds might cap out.
Yes, they'll capture less of that big upside. But importantly, this strategy also reduces volatility. That cash premium acts like a buffer if the market drops. It smooths out the ride.
Which is perfect for the market we're in.
Mm-hmm.
Now, I want to shine a spotlight on some of the actual companies inside these ETFs.
You have to look under the hood. And there's one name we absolutely have to mention because it's in most of these. Brookfield.
The heavy hitter.
Brookfield is an international giant. We're talking infrastructure, renewable energy. They own assets all over the planet. Ports, toll roads, dams.
They seem to own everything.
They practically do. Having Brookfield in these ETFs provides that global diversification. They're just masters of capital allocation.
It's like buying a mutual fund within an ETF. What else are we seeing in there?
Well, with that energy crossover in UMAX, you've got Pembina and TC Corporation, your major pipeline operators.
And on the communication side.
You see Rogers, because, again, internet and cell service are utilities now. They're the digital backbone. And, of course, you see Fortis. Yeah. You can't talk Canadian utilities without Fortis.
The classic.
The definition of a sleep-well-at-night stock.
So we've got the macro, the ETFs, the companies. Now let's get to the blueprint strategy. What does this all mean for your portfolio? How are we playing this?
So right now, our direct exposure to HUTE and UTES is about 5% of the portfolio.
And the goal?
We're looking to build that up to 10%. We want to double that direct exposure.
And where's that money coming from?
It's a strategic shift. We are watching the blockchain and Bitcoin sectors. As those areas improve, the plan is to sell some of that, losing exposure or stagnant capital, and rotate it.
Selling the volatility to buy stability.
Precisely. We shift capital into UTE and potentially add some direct UMAX. It's about rebalancing risk.
But, and this is a big but, we aren't turning into a pure utility fund, are we?
Absolutely not. And this is the warning. We don't want a defensive sector to be the key driver. It's the stabilizer. The engine is still U.S. technology, Canadian banks, and BDCs.
Right. Utilities keep the boat steady so the tech stocks can put wind in the sails.
That's a great analogy. You need both. If you go 100% utilities, you might miss the massive growth rallies. If you go 100% tech, the volatility might wipe you out. It's about balance.
So let's wrap this up. What's the takeaway?
The core finding is simple. In early 2026, utilities are not just a safety play, they're an alpha play. They're offering double-digit yields, and they're beating the SP 500.
And just to hammer it home one last time,
Yeah.
UTE, the winner at 13% total return, and UTES right behind with a solid 9%.
And that matters because of what that income allows you to do.
The nomadic connection.
Exactly. When you're designing a life of financial independence, cash flow is the fuel. You can't pay for an Airbnb in Bali with unrealized capital gains. You need cash.
That's the truth. You can't eat ROI.
Right. But these ETFs, with their monthly payouts, provide that liquidity. That is money hitting your account every single month that you can use to fund your lifestyle without having to sell your principal assets. It creates freedom.
It allows you to step off the hamster wheel. All right, before we sign off, a few reminders. If you are digging this case study, please post your comments or questions. We want to hear from you.
Yes. Let us know your favorite income strategy. Let us know what you think.
And make sure you subscribe. We're pumping out content about financial independence, passive income, early retirement, and, of course, nomadic life design.
And don't forget the monthly income portfolio reveal. That happens around the 20th of each month. We open the books and show you our moves.
It's practically right around the corner. Now, give us the voice of reason before we go.
As always, this is for educational and entertainment purposes only. This is not financial advice. We don't know your specific situation.
Especially regarding margin.
Especially that. Borrowing to invest adds a whole new layer of risk. Do your own research. Consult a professional and make decisions that fit your goals.
Couldn't have said it better myself. Thanks for tuning in to this case study. We'll catch you on the next deep dive.
See you then.